Good morning, everybody, and welcome to the webinar. Welcome members of the panel and welcome auditors. Before I introduce the members of the panel, I'd just like to go to some administrative issues. First of all, it will last an hour and a half, so 90 minutes. At least that's the maximum that we have planned for this session. You will all be muted except for the panel members, but if you want, you can send us our question via the system. They will be answered, we'll make an answers to the questions, we'll group the questions and we'll answer them, and you'll find the answers on the web. This webinar will also be on the web from tomorrow on. On IESE's web, you can find the recordings of this webinar, and we'll invite you to go to them or indeed share them. As you'll see, I'll have a bunch of questions regarding to the two studies, and for each study, I will present them to a panel member. Nevertheless, I will invite contribution from the other panel members. Welcome to this first version of this webinar, and I'd like to introduce our wonderful panel. First of all, we have Sara Rosenthal, who is a principal at TTCR, and well-known investors in search funds. Sara also has worked for the Center of Entrepreneurial Studies at Stanford. And so she's been involved in all of those studies, and so it's a great person to have on this panel. Welcome, Sara. I'd like to also introduce Coley Andrews, one of the co-founders of Pacific Lake. Coley has been investing in this world, forever, and it's great to have you on the panel, and thank you for accepting, Coley. Peter Kelly, you will find Peter Kelly's name on both reports, so Peter can really talk to the content for the report, but also Peter has been a serial investor for a long time, and Peter has been one of the earlier searchers, so he's an investor as well, someone who knows a lot about searches, and he displays his knowledge to the students of both Stanford and IESE. Thank you for being on the panel, Peter. Simon is based in London, and Simon was and is still the first searchers to have done a search very successfully outside the United States, and has been a serial investor ever since. And last but not least, thank you for joining us, Will Thorndike, well-known in the search fund community, who has invested in hundreds of searches, and I think his knowledge in search and search fund investing is just astounding. So thank you for being on the panel. I will moderate this panel. My name is Jan Simon. I'm the Associate Academic Director of the IESE Search Fund Center, and I'm also the managing partner of Vonzeo. Before we start, I'd like to especially mention two people. Sara Rosenthal has done from the Center of Entrepreneurial Studies, who has done an excellent work in making this report. Sara, from the entire community, thanks a lot for doing so. We know how much work goes in that. You did a fantastic job. Same thing is true for Lenka Kolarova, from the International Center for Search Fund Studies at IESE, who's done an excellent job also on the international side. Thanks so much for your help and support to the community, but also to making two wonderful reports. Thanks a lot. Before we start, I think I also want to especially acknowledge two people. The first person is Irv Groesbeck. Without Irv, none of us would be sitting here. None of us would be on this webinar. Irv's vision, Irv's understanding of the model, the development of the model, and energy behind it has just been stellar, and the entire community is aware of that and acknowledges that. From the international part, nor Simon nor myself would be here if it wasn't for Rob Johnson. Rob Johnson has really pushed forward the understanding of search fund internationally and has been a driving force behind it. Both Irv and Rob, from the entire community, thanks a lot for us being here and for all your energy and vision in that. Good. Having said that, I'd like to start and open the debate. And first, I'll throw the first question to you, Peter, who's been involved in both studies. Having been involved in them, are you seeing noteworthy changes in the data?
I have seen some. We have seen some, as I'm sure people have noticed. Thank you all for joining us to hear about our early thoughts on the study. So I think there's some big trends. More and more people are doing it, of course. The numbers of people who are doing it have increased in the last, say, 4 years quite a bit. They still are small compared to the number of small and medium-sized enterprises looking to for transition. But some other things jump out. People are doing it from many different backgrounds. It sort of started at Stanford and Harvard and in the US, and now it's really spread to other places. And as people learn about it, people are doing it from many different backgrounds, even some without business school or graduate degrees. IRRs are stable. It's really kind of remarkable to me that with such a growth and diversity of people doing it, that the IRRs are stable. The MOICs have come down as the hold periods have come down and as there are more people doing it, because by definition, there's a big group of acquired companies which are only 1, 2, or 3 years old. So there's no chance for the OMICs to be as big. But also hold periods are shorter. You see some companies selling earlier. And while that locks in liquidity and locks in results for investors and the entrepreneur, we have seen a number of cases where people are leaving a fair amount of money on the table for the next owner. So that's notable. And I would say there's a lot more capital. So the last thing I'll mention is the growth in capital interested in search funds has outpaced the number of entrepreneurs interested in doing it. So we noticed that there are more kind of professional investors, some of whom form funds or some of whom are just dedicated to it. So that's the last trend I'll mention. And I'd like to open it up, of course, to Coley and Will and Sara and Simon and anybody else Rob would like to mention anything.
Coley, you want to have a shot at it, or?
Yeah, sure. Just to pick up on Peter's thread, I thought one of the most interesting things that stood out to me in the international IESE study, which I believe will be released publicly very soon if it hasn't already, was that if you look at, the data is still very small, but if you look at the performance of the acquisitions around sort of 2010, 11, 12, 13, 14, it's very, very consistent with the universe of data that we've seen in the Stanford study over the last decade plus that study's been performed. The N is still super low, so I think it's hard to draw any sort of definitive conclusions, but it's an early indicator that I think what we all believe, which is that the model is transferable outside of the United States into other geographies, because the principles that make it work so well apply regardless of geography, political boundary, and cultures. So I was really encouraged to see that, even though it's still a small N.
Let me just note that the study will be sent to everybody on this teleconference. So we're releasing it immediately after this.
Simon, is that something that you see too? The same uses? Because
absolutely.
Nationally, so you have a good grasp of that too.
Yeah, one of the things I found most encouraging is the growth of the international search funds, because from my perspective, it's taken a very long time to sort of warm up, but now it sort of seems to be happening in an awful lot of countries, which is fantastic to see. One of the concerns I had, and I think a number of investors had, is it replicatable in terms of returns because of the size of domestic markets? And I think it's very encouraging that early signs, and they are early signs, but they're very positive. So if you look at the population of search funds, international search funds, the returns are skewed because many are very recent, so they're quite low. But then if you look at the distribution, I think there's 5 now that have had 10 times return, or look like they'll have 10 times return for their investors. And they're all still running the business, so that's great. And sorry, I guess the assumption I've made there, which I expect other people know, is that most of the returns come in the later years, so years 3+. So if it's years 1, 2, or 3, you'd expect them to show lower returns than for later years. Does that make sense?
Yeah, important point. Thanks for all of you. I think Will, I think you made a fantastic presentation, or you had a fantastic panel at Stanford who was talking to that. When does shareholder value creation really kicks in? You want to say something about that?
I was just going to say, Jan, I think the similarities are really striking, and the IRR is one piece of that, but it's also remarkable to see similarities in terms of the size of company purchased and the multiples paid. So it's remarkably similar. And then the growth that Simon mentioned, literally 1/3 of all international search funds have been raised in the last 2 years, right? So it's an extraordinary, extraordinary and exciting and very exciting trend, I think.
So you agree on that? So you're shaking your head, and I know you're pretty active internationally, so.
Yeah, no, I mean, I agree with what all the panelists have said, and actually in a conversation Simon and I had previously, another trend we're seeing, at least in the US, are more and more geographic searches. And as you see people focus on a narrow geographic area, in many ways, it's like being focused in, you know, the UK if you do sort of a West Coast or California search. So there are similarities there, certainly, and it's really exciting to see, and especially interest too from international investors as well in adopting the model in their home countries, which of course does take a while as well, but we're seeing some really good interest from investors in the home countries of the searchers who are raising there.
Wonderful, wonderful. Anything you outside United States you want to mention, Sarah? Is anything you see differently that happens outside the United States, which is not necessarily happening in the United States, or certain countries that you might mention?
Sure. We, you know, there's numerous differences. I would say, you know, consistently we see really great entrepreneurs internationally. At TTCER, we have a pretty heavy focus in Latin America, with most of that centered in Mexico, just because as far as international search fund markets go, that is the most mature. But obviously, especially in Latin America and those emerging markets, there are just structural dynamics there that make it so that there are opportunities for acquisition that you just wouldn't find in the United States, just given where the markets are. They're just really interesting opportunities that are maybe you would have seen in the United States 20 or 30 years ago that we are really excited about. So commonalities among the entrepreneurs, but the opportunities are different. And of course, there's the political situation is different. The economic situation is different. We may talk about currency later. So there's other factors certainly you have to take into consideration. But on the whole, we've had great success investing in these emerging markets and are really excited about the possibilities there.
Wonderful. Recently, there have been quite some exits in the US. Will, would you mind sharing some reasons and implications for that?
Sure, Jan. I mean, just to frame that, if you look at the most recent Stanford study, I think in 2018 and 2019, there were 22 exits, which is 11% of the total search fund companies ever acquired in North America, right? So it's kind of a remarkably strong trend. And I think there are two primary reasons for that. The first is it's a rational reaction to what was, over that period of time, a kind of uniquely heady, frothy market in the US. If you look at sort of PE multiples paid, leverage levels, kind of any of those key metrics, those 2 years were the high watermark in the last 25 years, except for one brief window in the first half of 2007, right? So part of that, I think, is just a rational reaction to market conditions. The second is a related, I think, incentive effect. In at least some of those companies where you had successful search fund CEOs who were sort of 4 or 5 years into running their company, even if they were excited about the prospects for the business going forward, given the condition in the markets, it was a rational decision for them to try to seek an exit to bulletproof their performance-based economics. Right? So I think that's sort of highlighting an incentive effect, and one that the community is really, I think, still figuring out how best to deal with in kind of that unique circumstance where you've got an excellent company with a bright future, but where there are very high current valuations and a management team that hasn't yet fully vested into its equity. So I think there was an incentive effect on top of the broader kind of market conditions.
Do you think that's going to be addressed in the near future?
Absolutely. I think that's a front. Yes, Jan, I think absolutely that's a front and center topic for the whole community now, and very much under discussion. And board, it's really a topic for boards in a number of cases that I think all of us are aware of. They're actively addressing that as we speak. But there'll be more and more of that going forward, I think.
Wonderful. Any of the other panel members wants to add something these exits and the reason behind them or implications, as as we'll refer to?
Well, Will brings up an interesting point, which is the increase in multiples in the private equity world and also in the exits of search fund companies. I think what's striking is that there has not been an increase in multiples in the entry and the acquisition of search fund companies. That's really surprising. I think it shows a lot of discipline, maybe too much discipline, because the reasons for the increase in multiples are many and going to sustain, I think, for a while. They're really low interest rates. There's a lot of capital looking for acquisitions. There's maybe lower returns expected from private equity investors because the institutional investors are accepting lower returns now. There's a really powerful incentive for private equity firms to invest the money. They make, by my estimate, which is not professional, they make maybe half their money from the fees they earn, not from the returns. And so they just want to get it. They're incentivized to invest it, and it works for everybody. So I don't mean to say there's anything nefarious going on, but my point is more that I think multiples are going to stay high. Exit multiples will stay high. So maybe search funds could pay a little higher multiple, but they've been very stable and disciplined. And the exit multiples could reverse if interest rates go way up, if there's a lot less money in private equity, for instance, or if the terms of private equity partnerships change. But I don't think it's going to change. I will say there's more variability in the multiples being paid. You can see in the data, as we look at it, there are more people paying kind of low multiples and more people paying high multiples. So the average has stayed the same, but the average hides some variability. For instance, for healthcare companies, but particularly software companies, higher multiples are being paid. But then that's balanced, as the average shows, by sort of more mundane business models where people are paying even, sort of 4 times, 5 times, 4.5 times. I just think that's something to watch. I don't worry about the high multiples for exits, because I think part of that is driven, let's say, I'm making this up completely, but 70% of it, say, or 60% or something like that is driven by just improvements in the companies of the search fund company over 7 or 10 years, which is much more professional management, a deeper management. Instead of one owner manager, there are 5 or 6 people who are helping run the business, bigger companies, more stable business models, more professional sales process, better metrics, better financial reporting, better legal risk management, and so forth. It just naturally you're going to pay more for a company like that, but it's something to watch.
Peter, Jan, can I ask Peter a quick question? Peter, as you just given your involvement in the Stanford and IESE studies, as we see more and more technology companies coming into search, do you think there will need to be an adjustment for how we look at the purchase multiples, just given how searchers, how we look at that in terms of based on an ARR basis versus an EBITDA multiple?
Well, yes, but no. And also because of this, multiples of ARR are just a short, in my view, Will would have a good opinion on this, maybe Coley would too, are just a shorthand. They're a shortcut for future multiples of cash flow. So, you're using other companies that have grown and thrown off cash in the future, their multiples to sort of look at value companies now, but it's not the only valuation. You really have to project future cash flow. That's what the value of companies. So it's just a shortcut. We should, acquirers should be, and investors should be digging underneath that shortcut to really understand what's happening. Technology companies usually that are bought by search funds aren't really technology companies. Technology is just a way of delivering a service, often to a business, and it's by the internet or SaaS or data or whatnot. But I think that we need to understand those, but we also need to understand healthcare companies. Those are more complex. And I think there are more technology companies being bought, partly because they're more entrepreneurs who are facile with technology, with software and data, and they've come well trained from good, bigger companies in those areas. And also because it's just the way more stuff is being delivered and it's not that complex. Now, there's certainly technology companies that are very complex, and mostly it's technology being delivered and it's highly technical, and those are probably less appropriate for most search entrepreneurs.
But a question that comes in from the people watching us, is there a difference when it comes to performance in countries like Spain and UK? I assume the data is not big enough to talk about that, but Peter, you've been looking at the data. Would you think there's anything meaningful to say about geographic areas already at this stage, or is it too early?
I think it's too early. I think, you know, it's hard. It's a smaller market. I don't think the competition among search funders is meaningful. I think there are so many companies that are going to be looking for transition that there are enough companies to buy even in markets where, like Spain, where there have been, you know, 5, 6 more entrepreneurs looking at the same time. The differences between the markets don't look meaningful. I think there's potential for good returns in both, really good returns. There's potential for mistakes in both also. You know, one thing I'll note that comes to mind is in some of these companies like Spain, Italy, Germany, I've seen search fund entrepreneurs expand the companies to international markets. They buy companies that are addressing the domestic market, but because of their education and maybe their language skills and their orientation to the world, they are then able to address other markets. But I don't see, there just aren't enough ends yet to see meaningful differences in likely returns between those markets. So I'm curious what Will would say, for instance, on this.
Can I just check with Simon, because Simon, you were the first person to do it in the UK, and I know you're an active investor both in the UK and Spain. Do you have any view on that? Do you see meaningful differences, maybe in terms of companies that are acquired, the environment?
Well, debt is one of the areas where there's been a difference, and availability of debt, which you think must fall through into returns. And you know, the data points are very small at the moment. I think if you've got a vibrant economy, or you've got an economy, because you know, the current situation has proven people can still make money through some very difficult times. But you know, it's possible for talented people going into good quality businesses to make a real difference. And that, I think, is perhaps the most important fundamental. And do you get that in the US, in Spain, in the UK? Yes, you do. Do I see any significant difference in the returns? It's just too few data points, unfortunately.
Okay, great. Coley, you invest everywhere. So do you have any different views or any general trends that you see internationally to that respect?
Well, yes and no, but I want to jump on what Simon just said there, because I think there's a really strong point there that takes both the historical data that we're talking about today between the two studies and the current reality of the world we're in today, which is the opportunity to buy and build great businesses has been determined from the Stanford study over 25 years, seems to be determining in the IESE study internationally. And if we look at sort of the performance of searchers today in the last few months through COVID and their ability to buy very good companies at multiples that are consistent with what we've reflected in the studies here, that has proven to be exceptionally true. And then the performance of the active portfolio generally of companies that have been acquired with the characteristics that we all talk about and can talk about more if needed here has proven that kind of durability right through this crisis. And I think that's it's a super important point for all the folks out there that are considering or thinking about this path. This path now has been proven through multiple decades, multiple cycles, and certainly my conclusion is being reproven again right now, both on the ability to buy and the ability to successfully grow through challenging economic times, so long as you're buying businesses that exhibit the characteristics that generally are a good fit for a first-time CEO. So that's a super encouraging sort of non-present piece of the data from the studies that I think is relevant, though, to the world we're all in today.
Just add, sorry, Will, go on.
Picking up on what Coley just said, which I agree with, and I agree with what Peter said earlier about, you know, it's too early to tell. But Simon made an important point. If you sort of look at the components of return in the emerging data set internationally, Europe, the transactions in Europe look more like US search deals in that they have a component of leverage. They're not highly levered, but they have a component of senior and seller financing. In Latin America and in more emerging markets, the components of return are different. There's less leverage, less availability of leverage, which means the organic growth piece is more important, right? But to Coley's point, we've seen success in both of those markets, right? So the search model has proven to be robust across both those geographies, but they are a bit different in terms of how the how the long-term IRRs are achieved, what the components are.
Good, wonderful. Simon, you wanted to add something, or you fine?
Yeah, the only bit I would add there is the importance of the board or the local investor support, and having good quality support around the entrepreneur, I think is a common characteristic that's absolutely essential. That makes a big difference. Yeah,
sure. A question that is often asked, and one that I see again now, is, solo searches versus team searches. We get the questions a lot from people who are thinking about doing that. They have a good friend, or should I do it together with somebody from business school? There is some reference to that in the study. Now, Sara, do you have any view on that? And you of course have a long history of being on top of those studies, on seeing those teams and also those solo searches developing. So I wonder what your take is on this.
Sure. I mean, if you look at the data, it's clear that partnerships are overrepresented in the higher returns, certainly, and that's been consistent for the last few studies when we started looking at it. I think if we took a little bit of a deeper look at the data just to try to unwind that a little bit, and as it turns out, partners and solo searchers end up buying companies that are about the same size. They have about the same hold period, so there's no significant differences there. But intuitively, it does make sense that two brains are better than one, just in terms of buying a company when you divide and conquer the leadership responsibilities, really tackling the big issues. So there's some rationale there, but that said, I have a lot of searchers who come and ask whether whether this data influences our investment decisions. And I can, really truly say it doesn't. It's not, and I think a lot of investors feel the same. So really what I encourage searchers is make the right decision for you. It's just, a great partnership is great, but only if you're working with the right person. And a lot of times people can't find that. So I certainly wouldn't force it. And for those folks who do end up doing a solo search, I think the most important thing is to really get creative about creating capacity quickly once you are up and running a company. So bringing on a junior partner, or hiring a great C-level right-hand person. I think that's really important if you are a solo searcher, and can add huge value if you don't have a partner.
Coley, would you agree on that? Because you have a lot of data on that, I assume.
Yeah, I think the way I look at the data that's published versus our own experience is it's directionally indicative, but not conclusive that partnerships systematically outperform. Our experience has been both have worked very, very well, and we are excited to invest in both. It's really a personal decision. I agree with Sara's comments. I don't need to repeat them. I think there's also more nuance sometimes when you've got two people and one person may want to leave at some point and then go on, the other person can continue on. Or some solo folks end up hiring an equivalent of a partner to join them very early on in the operation. So there's just a lot of variability that goes into that. But the principles of building a new team, bringing on talented people who want to help you build and grow the business apply, whether you're a partnership or you're a solo person. And I do believe that is a significant driving factor in creating long-term value. The human capital side here across the top level of the organization that you build really inflects the business in a way that likely the previous owner just wasn't interested in doing. Not that he or she wasn't capable, just wasn't interested. And that provides the big opportunity for the search for an entrepreneur.
Wonderful, thanks. A question that is often posed is which type of companies to buy. And I know, the Stanford study and the primary, give a whole bunch of, ideas about that. And I know we all like to see recurring revenue, or I assume we all like to see recurring revenue. It turns out in the latest study that Peter and Sara looked at, it doesn't seem to be as conclusive, I thought, that it would be. And so Will, I know you've been a pretty big proponent for recurring revenue too. I wonder if you could talk to that, like in general terms, what are characteristic that you like to see, and also specific about recurring revenue.
Yeah, thanks, Jan. So I think the Stanford study under, Peter's leadership and Sara working on it, that has increasingly tried to zero in on, kind of the economic characteristics. I would say as it relates to recurring revenue, it's very hard to characterize that precisely across a large data set. There's a component of that that's just fundamentally not simple to quantify precisely. And so I think you have to be careful drawing conclusions so far. I'd be interested in Peter's thoughts from I think the study is sort of on a journey to precision around that, that criterion would be my read of it. But I think, I think recurring revenues, it's almost impossible to overstate their importance to search fund entrepreneurs and investors, so there's sort of three basic, and the specifics of that are, I think, I would define recurring revenues as a consistent pattern of repeat business from existing customers. And the two key metrics there are, I think you want the recurring revenue stream. There are often other revenue streams, one of which is truly recurring. You want the recurring revenues to be the clear majority of revenues. I think 60 to 80% of total revenues is the target there. Then within that recurring revenue stream, whether it's contractual or a pattern of repeat business, you want to be able to measure churn. There are different ways to look at churn, but the first cut is customer churn. And you basically want businesses with single digit churn. And I think kind of the threshold there is 20% churn. So you want 20% or under. Single digit is substantially better than double digit. And there are three things that are powerful about recurring revenue for searchers. So one is it's just inherently resilient as a business. It adds resilience to your business model. So that's resilience that's helpful during economic downturns, but also with inexperienced CEOs, right? So there's power in that. The second is that recurring revenues allow for some use of leverage in asset-light business models that would otherwise struggle to attract debt. So they actually, they help the IRR math in that way. And then the third one might even be the most important one is recurring revenues. It has a very powerful impact on how a management team can spend its time, right? So if you're the CEO of a recurring revenue business, you don't need to worry about where the next quarter's revenues are coming from so much. And it frees you up to focus on more strategic, longer term projects that often can really move the needle on equity value longer term. And I would just say anecdotally, if anything, the last 6 months has strongly reinforced or underscored the power of recurring revenue. I could literally take the companies I'm invested with, force rank them by the strength of their recurring revenue. It would be a pretty good proxy for their performance over the last 6 months in the COVID period. So I do think very important, yeah.
Definitely, if something reduces the risk in acquiring a business is if you have recurring revenue. So Peter, was there anything else you looked at in terms of recurring versus repeat, or any views you have?
I think Will nicely said that our survey questions were imprecise. And I would agree.
Dramatic oversimplification, Peter. Yeah.
You're too kind. I think they probably don't get at the important components of recurring revenue. I agree with him about the ways to look at it and think about it. And for those who know SaaS companies at all, some of the SaaS metrics are very appropriate for other kinds of businesses in terms of measuring recurring revenue, churn, revenue churn, net revenue churn, customer lifetime value, ratio of customer acquisition cost to customer lifetime value. All those things can tell you a lot about the business. And so I think people involved in a lot of companies are trying to get deeper into that. So, as you're looking at businesses or thinking about it, you should just be thinking levels down in recurring revenue.
Wonderful, thanks. Coley, you want to add something?
Yeah, I think so. For me, there's a little bit of kind of how does this conversation, which I agree with, tie into some of the numbers. And I think there's something interesting to look at in the numbers, both primarily in the Stanford US study, but perhaps over time as well in the international study, which is despite sort of a gradual decrease in the MOIC, there's two other, which is not surprising for a variety of reasons we can talk about. I do think that there's something notable on sort of the gradual increase in the IRR, which could be some of the factors that Peter talked about around market timing and what have you. But I do think also correlates to the quality of the business model, which gets to Will's point. People are willing to pay a lot more for better businesses, which gets to somewhat to exit, or gets to exit multiple, but that's not just market timing. And then I also think there's sort of a distribution issue, which is probably the most important thing for not just investors, but entrepreneurs around probability of having a positive versus negative outcome. And that data is also increasing. I think historically it used to be 2/3 of acquisitions had a positive return on capital, 1/3 did not. Now that number has moved up into the 70s. And I think if you even look at the last 10 years of a variety of portfolios, you will see numbers that are up in the 80s and maybe even the 90% range of positive versus negative return outcomes. And that directly correlates to this conversation around the power of business model durability and recurring revenue to maximize your probability of having a good outcome.
Wonderful. Anything on top of recurring revenue that you think should be like in the top 3 of things to look at?
Yeah, I was going to ask Will as he was talking about that, where secular growth comes into play in parallel to recurring revenue. But I think that's the other lesson through the last 6 months, and certainly probably is persistent in the businesses that have had longer term success in the various studies. Having that tailwind is just the ultimate gift you give yourself, to have both a longer runway to go, the ability to navigate choppy time periods such as one that we're in now, and then the ability to create a business in a way that you would hope to, which is kind of without a ceiling. And so that's the other piece here that's pretty clear. And both of these secular growth, it ties into the quality of the product and the service being provided, the business model, but that mission critical component, when you put all that together, that's a pretty powerful trifecta, I think, to try to find. And then once you have it, gives you enormous degrees of freedom, as Will said, as a CEO, to really invest in building the business, in working on the business for the future versus working in the business on a day-to-day just to survive and make your next sale.
Add one more thing. Sorry, Jan. I was just going to say, I totally agree with Coley about the secular growth, though borrowing Will's awesome term, I think in terms of the search fund study, that is also on a journey to precision, just in terms of how we correlate the industry growth with the actual returns. That correlation there is, I think, as investors and entrepreneurs, everybody's quite clear on that, but it's a little harder for the data hasn't quite proven that out yet. And I think it's just because it's harder to be very precise and actually nail that in terms of what the industry is that the entrepreneur is entering when they buy the company, how that transitions from the time of acquisition to exit. So I think the point being, I totally agree with what you said, Coley, and even though the data doesn't necessarily prove that out as we have it today.
So what must be interesting for Peter, in the Stanford, your data starts to become bigger and bigger. So there's more kind of research that you can provide, and I think that's probably exciting to work to do the next study.
Yeah, there's so many more things we would like to get into in the study. We hope to. Fantastic.
There's a question for you, Simon. How have you seen COVID impacting the search fund from looking for a company to searchers raising capital to doing due diligence or indeed closing a deal or running a company?
Sure. I mean, in my experience, it's certainly making it more difficult to find good opportunities because, not surprisingly, the entrepreneurs running the businesses are busy working out what's going on for their own business and then going to market. I think similarly, when you look forward, they're probably trying to work out how they steer the business forward so that they know what sort of P&Ls we're presenting to market. So, I think it's a bit of a slowdown there. That said, deals are still getting done. And certainly the deals that were on the table just pre-COVID, while they went on hold for a period, it gave an opportunity for investors and the entrepreneur to see how those businesses would perform during a really difficult period. And I've seen many of those deals go through now. but perhaps with a different price, or at least an element of contingency within the structure, more defensive for investors, which I think is, has been really helpful actually from an investee point of view. I've certainly not seen a reduction in the number of people wanting to raise search funds. And that could be because this is a good time, because over the next few years, I expect businesses will come through. But it could be due to a lack of opportunity elsewhere, possibly. So people might be looking at it for that reason. So I think they're the big impacts. I guess due diligence is obviously a bit harder to do, and people have to rely on Zoom. But one of the things I've been shocked about, pleasantly surprised, is how quickly we all seem to have adapted to the new technology, and how an awful lot of business is going on business as usual. Some obviously have come to a horrible standstill, but a lot hasn't.
Yeah, I have seen several cases where actually the searcher is helping the seller, dealing with COVID, which is just wonderful.
Yeah, an extra pair of hands.
Yeah, exactly. So, what are your feelings about this? What are you seeing at TTCR?
Yeah, I think I agree with all of Simon's observations. At least by our experience, it certainly hasn't slowed the number of searchers coming to market fundraising for, I think, many of the reasons Simon mentioned. And I think that's been one thing that's been interesting to see in terms of searchers looking for companies to buy. There are sellers who, 6 months ago might have been willing, or owners who might have been willing sellers 6 months ago, who have just totally hit the brakes on selling because they want the market to recover, so the valuations go up. And then there's other folks who probably hadn't even been contemplating a sale, and this has changed their mind a bit about how they want to spend their life going forward. And so I think there's new opportunities coming forward that that weren't otherwise there. So net, I'm not sure how it's gonna sort itself out, but ultimately I've been pleasantly surprised with the amount of activity that has continued despite all the upheaval in the world. Thanks.
The next question, and I like to ask that one to you, Coley, because I know you have strong views on that. I think you have strong views on that, or at least a lot of data on that. The question often, should I do a deep dive search, or should I do more of an opportunistic search? What would be your suggestion to somebody who's embarking on a search?
Yeah, so I think taking a big step back on this topic, like if your goal is just to buy a company, there's lots of ways to buy a company. And both paths can lead to buying a business, meaning an opportunistic banker broker driven approach or an industry sector driven approach. It depends on what your goals are, how you're thinking about your search, geographically constrained or not, or what have you. So I think it's important to name that. In our experience, or my experience, there's just a huge delta between running the industry thematic driven search approach if you really do it to become an industry insider, to become a subject matter expert, to become someone who can actually help a business owner in a time like this because you have some credibility around the space. And in our experience, what we've seen is actually a close rate to buy a business when you're actually running that type of model versus not. It's a 2x difference in the probability of buying a business. It's significant. And furthermore, per the conversations we've had earlier, buying into a good industry with a secular tailwinds then just gives you enormous degrees of freedom for the future. You can change the company and the business model, as many people do over time. You can change your management team out, as everybody does over time, but you can't change your industry. And it's a super important part of maximizing what you can ultimately do with the business. But as it relates to just buying a company, it is, in our opinion, a distinguishing factor in your probability of buying a good business. The question that immediately comes up is like, well, that's easy to say in the US where it's a massive liquid economy. It's much more challenging outside of the US. And I agree with that. I think it is. I think it's an individual decision for the searcher based on where they are and what country they're in to decide what type of approach she or he wants to run. I still think the principles apply on the thematic industry-driven approach and would encourage folks to think about that. The challenge is you might not have as many targets that you can turn up in your specific geography. And that will be a function of how big of the industries are that you consider in that country. So it's important to name there's a difference for sure, I believe, between North America, or at least US and Canada, and the rest of the world. But again, the principles I think still apply. And in fact, there are many examples which folks know about of where industry-driven searches outside the US led to businesses being started in a very successful way by search fund entrepreneurs, which I think just further reinforces the importance of getting yourself into that good industry sandbox.
Thank you. Will, in the past, I've heard you saying to people talking about that, also to think in terms of business models, not merely in terms of sectors. Can you elaborate a bit on that?
Yeah, and I think we touched on this a little bit earlier, but I do think, the three sort of core, the two criteria that we talked about earlier, recurring revenues and secular industry growth, those are the two most important principles. There's a third one that relates to capital efficiency that might sneak in there for the bronze medal, but I think those are the top two. And it's impossible to overstate how important that is for searchers to focus on, whether they choose to do an industry-focused search or an opportunistic search. I think that needs to be an absolute prerequisite. As Coley said, you cannot change your industry. There are lots of other things once you're in the company that you can change. So I think that's critically important. And if you search outside the US, you do have the benefit potentially of looking to the US to see what specific industries have worked best there, and then to focus on those in your home countries, which may have less mature M&A markets. And at the extreme, there is a sub-genre of greenfield search, search to start, that's been more common in international markets. It's about 5%, it's about 10% of total closed international searches have been greenfield searches. But those are very specifically industry themed, and they're focused on industries that score sort of A+ on both recurring revenue and secular market growth.
Wonderful. A question coming from the public is that, in the Stanford study, for instance, there's about 1/3 not finding a company. So if you look at the step up, it kind of, makes investing in search fund and the search funds almost neutral. 2/3 find a company, and then you take the step up, that kind of equalizes. But it has been creeping up, Peter. Is there any reason for that you think is worth mentioning?
Yeah, it's worth mentioning, and you'll notice we have a sentence in the Stanford study that really 60% of searchers in the last 4 years have been buying companies. So 30% over, a little over 30% do not find a company in the whole study, but it's really kind of about 40% do not buy a company now. And I think that's from the variance that's coming in the searchers, and maybe in what the guidance they get on what company to buy. I saw a question in the Q&A about, is there better guidance on what kind of company to buy? There is for experienced investors. In the late 90s and early 2000s, I wasn't doing it then, I was running my company, but people bought all sorts of companies that were probably that didn't meet the criteria that Will so articulately laid out. Don't do that. I think that discipline has not been as strong internationally. I think it's getting internationally. I think it's also not been as strong as new investors and new searchers come into it. So I think it comes from just more variance. And, and also, frankly, it started off at about 25% didn't buy a company. That's pretty attractive. It's far better than starting a company, far better odds. So I think that's attractive for entrepreneurs to start and try. I don't know what the right equilibrium is for that, but it's somewhere in there, and people just need to assess. So the biggest thing is, are you prepared to do a great search and buy a good company in a great industry? And prepared means personal qualities and also your advisors, and that's a complex answer, but I think that's probably getting a little weaker as many more people have done it as both investors, but especially as entrepreneurs. So really, if you're an entrepreneur, I would say assess whether you're right. Use the Search Fund Primer personal criteria, use your friends, think about really whether you're willing to do what it takes to buy a good company in a great industry. And it's just gotten a little tougher. People probably, on average, the entrepreneur has probably not been as well prepared as they were before, when it was, they went through a class on it and they had investors who were all steeped in it and were guiding them very strongly. I'm not sure that's all bad, but it's something to be careful of.
Okay, so you would say there's just more supply of entrepreneurs trying to do that. Well, the quality of the business that they tend to acquire is better. Overall, there's also more people not finding it. Do you see that as a big risk for people doing it? 2 years of search with nothing to stand for, or is there a lot that they haven't transferable skills of doing a search?
I mean, I think about this all the time, and we talk about it. Sarah Heston and I talked about it, and the other people who teach the search fund class at Stanford talk about it. David Dodson, Gerald Risk, Jim Ellis. And the real risk is through this process, which is intense and exciting and scary and fun, that you make a mistake and you ruin your reputation or you damage it, because reputations can be repaired. It takes a long time, but under pressure, you do something dumb and you don't look out for your investors, or you lie, or you cut corners, or you cheat, or you do something like that under enormous pressure. That's the really big risk, because that takes years to repair that for your career. The second big risk is you buy a bad company and you're stuck in it. It's not so bad that it goes out of business quickly, or you have to sell it for complete loss of equity quickly. That's awful, by the way. But worse is you toil away for 4 or 5 years and you aren't able to turn it around, and you sell it for you don't make much out of it. You probably learn a lot. And if you act nobly in regards to your investors, then you probably have a good reputation. You can do something after it, but it's taken 4 or 5 years and it's painful. It's not fun. If you do next after that is if you do a search and you don't buy a company, that's not so great. That's 2 years, probably, maybe 2.5, including the fundraising and preparation, that you don't have a financial return to. However, you do have relationships. If you worked hard and thought of everybody's interests as you go and acted well, then you have good relationships. You've learned a ton about industries and about owners and about M&A and about due diligence and about being an entrepreneur. So that stuff I see people all the time take into their next career and do really well with. So that's not great. That's not what you set out to do, but it's not terrible. It's actually, you really get a lot out of it. So that's how I think of the risks, the downside for the entrepreneur.
Okay, Simon, a question for you connected to that. You were the first searcher in your country. Is there any advice you would have for first searchers in a country, which makes it probably a bit more risky and more daunting?
Good question. I think the first is more general advice to any searcher. Think about it really, really hard. Talk to as many people as you possibly can, as many entrepreneurs as you can, and as many investors as you can, to find out what it's really like. Because you can read all of the documents and watch all the videos, but talking to people, I think, is really helpful in that process. And the sort of self-assessment tools that Peter was referring to, because we as a group here are strong advocates of search and entrepreneurship through acquisition, but it definitely isn't for everybody. I think so. Knowing yourself and knowing how you could apply yourself is really, really important. I think in terms of being the first in the country, it's possible. It takes longer to raise the money. Well, it took me longer anyway. And I was only, I think, number 5 in the world. So, it was pretty new. It wasn't really a thing then. But I saw that it was really important that you had local investors. And even then I had some of the serial search fund investors come on board, people like Bill Egan. But having a cohort of local investors, I think, is incredibly important, because they obviously understand how business is done in the UK. And as much as we speak the same language, there are some significant differences still. And if I talk about the industry and the search that we talked about earlier, yeah, I'm a fan of the focused search too, as opposed to opportunistic. It is shallower because the industries aren't as deep, for sure. But searchers spend an awful lot of time and do an awful lot of great work, by the way, looking at an industry and analysing a company. And then to follow an opportunistic route, which is basically to throw that away and go on to the next opportunity, represents a huge amount of wasted effort, in my view. So I was encouraged by sort of Coley's data and what that shows. And yeah, I'd love to see people do more of that. I'm not sure if I answered your question there, Jan, or not.
Wonderful. Wonderful. I would just probably also add, and it's not always easy to talk to people who have not found a business or things are not working out well.
Yeah, I think, it's not just not finding a business, but it's being in some of those holes that people find themselves in where the business isn't going anywhere. But I think we probably all have been in when we were involved in some of those businesses as investors or on boards. And what surprises me sometimes in business is how you can get there in the end. And you can go through some pretty barren years in that process. But sometimes things can work out really well, but you can't necessarily see it yourself when you're down there. And sometimes, as a director, I can't see it either. But there have been one or two instances where it worked out incredibly well, and you just sort of keep going, keep driving it. And that loops back to where I started from. Understand yourself, because you've got to be passionate about this. This isn't a job, it's a career. And you've got to really want to do it. And that means you take the rough with the smooth. You've got to apply yourself and get stuck in there.
Wonderful. Anything to add, Coley?
Just one thing. I think it's worth saying that we have a fair amount of data now around what happens for those searchers who don't find a company. And the reality is they get excellent jobs and go on to thrive. Right? They get jobs often in private equity or related fields like that based on their search experience. That's a very valuable experience that's recognized in other fields as being valuable. So I think it's really important to sort of explore that branch of the tree and really understand what that looks like as you're assessing this as a career path.
I think that's a wonderful point. We'll also think that there's few environments where the learning is so steep. I think searchers after a year and a half, they're nothing comparable to where they started. And I think that's one of the great things about the search fund models. It makes somebody CEO. So even if the person doesn't find a company, there's still a lot of learnings in there.
But I think that's one of the. Sorry.
Go ahead, Simon.
But I think that's one of the things I love about the model. Sorry, I'm sort of passionate about it because that learning doesn't stop. I'm sort of an old lag now, but I'm now investing, and I'm such an amateur compared to the likes of Coley and Will, and I'm learning so much, and I've learned on this call now. So it's just brilliant as a career because you just constantly keep learning.
That's wonderful. So Coley, your name is mentioned. Something to add?
Yeah, look, failure is defined as a failure of effort or a failure of ethics. Otherwise, there are now dozens of examples in our community of folks who didn't buy a company, but then ended up joining an existing search fund company, ended up leading a spin out from a search fund company, ended up buying a company that came through an investor's network. There are examples of CEOs who didn't have good outcomes in their first venture as a young CEO, but were great people and the industry just turned on them and they reloaded and bought another business or started another company. And all of us on this call have been invested in those, and they've been wonderful stories to be a part of, not just because they've been successful on the second rodeo, but it's been a journey over 10 to 20 years with those individuals. And so I come back to Will's point on reputation. This is not easy, it's unpredictable, it is entrepreneurship, full stop. And that means there is nothing guaranteed. The only thing that's guaranteed is if you find yourself self-selecting into this community and you put yourself in your best foot forward every day of the week that you're doing it, the journey has a lot of opportunities that'll present itself to you over the life of a career if you choose that. And I think that's been a special realization for me over the last 10 plus years being in this world. The branches of the tree that evolve are much bigger than what it looks like when you're 27 years old in business school saying, am I going to buy a company or not?
Very true. Thanks.
Yeah, and can I chime in one last thing on this topic, just that connects to what everybody here has said is I do think that lots of folks end up self-selecting out of search. It is definitely not the right career path for everyone. And I think Simon made a great point there. You really got to do the work to make sure it's a good fit. But I do think a lot of folks are self-selecting out because of that fear of failure or the fear of messing up. And I think what Coley has said and Peter said and Will and Simon have said are all right on. We wouldn't be investors in this space if we expected search fund entrepreneurs to come in and nail it every day on every decision every time. We completely expect and recognize that is part of the journey, making mistakes, not doing it right. That's why it's structured the way it is, to buy these businesses that have recurring revenue so there is cushion to make mistakes, to have a really strong board and a team of investors who can help advise along the way. And so mistakes are expected. It is only this failure of ethics, as Coley mentioned, or failure of effort. That's when problems arise. And those are few and far between. And not everyone's going to get the 20x return. But again, it's all part of this journey. So just, I would encourage people not to self-select out because of that fear of failure. It is, there's something good that comes out of this no matter where you land in the journey.
Thanks, Sarah. And I want to stay with you because it's a topic which is, I know, close to your heart. You know, both studies show that there's very few women, you know, pursuing such a career. You know, we don't have data on minorities, but from what we all see, the minorities are underrepresented. If you look at the minorities and women at business schools, and if we see then the population and search funds, there's a big gap in there. You know, can you talk to us, you know, why that is and what's being done about it?
Sure. Sure. Yeah, the data, you know, the data is very stark. It's no secret that minorities and women are significantly underrepresented in search. In the GSB Search Fund study, 21 searchers out of 401 over the history that we've been collecting the data have been searchers. And the percentages are similar for IESE, as you said, Jan. We're not currently collecting the data on race and ethnicity, but we will change that. It's a really important topic and one that we are going to be laser focused on going forward. That being said, there is good news. So investors are very aware that this is an issue. They are incredibly enthusiastic about backing women and people of color. I spoke with a female searcher the other day who said investors are, you know, throwing money at female searchers. That's been her experience and many others. You know, investors are enthusiastic. In this past year, there's been 2 initiatives that have been launched, the Women's Search Network and the Black Searcher Network, both of which started really with a mission to recruit more women and people of color to search and to really support and connect those people who have already chosen this path. And they're new initiatives, but I'm really excited about the possibilities that they have. And you know, we could have an entirely separate call about the hypotheses about why this is the case and how we've gotten here. I think really simplifying it, I think, you know, it is a reflection of the composition of business school classes from, you know, 2 and 3 decades ago, and the people who have become leaders in this space. One of my favorite quotes is from Sally Ride, "You can't be what you can't see." I think that dynamic holds here. However, I think as more women and people of color in search are rising to the CEO role and getting in front of audiences, talking to prospective searchers and searchers, being mentors and advisors, I think the flywheel will really kick into gear. And people have the opportunity to learn from one another through these groups like the Women's Search Network and the Black Searcher Network. I'm really optimistic that the virtuous cycle will kick in and we'll really start to see some positive change.
That's wonderful. I know, Coley, I know it's something close to your heart also, and I know that Pacific Lake does efforts for that. Do you see any change? You know, what do you see and what do you hear?
Yeah, huge change, which has been just super exciting. Now the numbers are still small, but relative to what it was before, significant change. So from 2010 to 2015, I think we spoke to less than 5 women who actually raised their hand and said, I would like to do a search fund and would like to come and talk to you about it. That's over a 5-year period. And in the last 12 months, we've invested in 6 women out of, you know, probably 20 or so new searches that we've committed to. That's a significant change. And obviously it's not reflective of the balance of the population, but as Sarah talked about, there's some composition, probably things that relates to history, but also current composition of the MBA class and what have you. But it's a really big change and it's the way it should be. It's exciting. And I think as we roll forward over the next few years, and more folks from all backgrounds buy businesses and have success because they will. then it will begin the compounding for the future that I think will be great for the community, for the ecosystem, for a whole host of stakeholders out there who are excited to be a part of this. So I am really optimistic about it. The data is super encouraging, and you know, it's awesome. It's awesome to see a wider range of people saying, I want to do this and I'm going to go do it. And that's part of what makes being in this ecosystem so great. You get a chance to help get people started in their own journey that they are going to lead the day they get out of business school.
Wonderful. Thanks for that.
Yeah, can I speak one follow-on point? So I think if you add up the number of companies acquired in North America and internationally, it's about 250 companies. It's worth noting that those with women searcher CEOs have extraordinarily good relative results. And one of the top 5 outcomes of all time, 5 out of 250, is a woman CEO, despite their dramatic underrepresentation in the total N. So anyway, exciting.
Great to see more. Thanks for the data, Will. Will, we often talk about the importance of the cap table, and searchers often ask us, what is an ideal cap table? Can you share some light on that?
Yeah, so I think cap table, or sort of investor group composition, is, along with, we just spent a lot of time talking about industry as one of the key levers over which searchers have control. I think the second most impactful lever over which they have control is investor group composition. And partly because that's partly because investor groups are sort of the seedbed for the board, for the eventual board. And it's, I think, almost impossible to overstate, Sara talked about this earlier and Simon did too, just how important search fund boards are to the ultimate success in search funds, to sort of the partnership and mentorship that goes into boards working with CEOs. And so I think kind of key variables there are, search fund boards tend to be very small, tend to be about 5 people on those boards, and very actively involved. And I think you want a mix of people who have prior search fund experience. That's at an enormous premium. Both operating experience, people who have run companies like Peter and Simon successfully, and then people who have prior experience as investors in search fund companies like Coley and Simon and you, Jan. So those are complementary experiences, but the search fund is sort of a unique animal, to very different and important ways from private equity. And so people who have experience both operating and investing, a blend of those two perspectives, is really important. And then as it relates to international searches, I think there's an important question around the critical role for local investors. As Sara mentioned earlier, local investors are really important in international search, but I think you also want some deeply experienced serial search investors who may come from outside of the local geography, that there are benefits to having both perspectives represented on the board. And if either one is overrepresented, that may not be perfect. That may be a flashing yellow light. So I think, it's really the cap table and eventually the board are just, huge determinants of potential, sort of long-term success for searchers.
Thanks, Phil. Peter, anything you want to add in terms of advice to potential searchers, especially also abroad, when they have to put in a cap table which has partly local investors, which nobody might have heard of, a search fund if they're the first searcher, and of course partly international? Who kind of should come first, and what would you advise?
I think it's different in different markets. I think Europe is different than Latin America. I'm sure countries within Latin America are different than each other also, but those are big differences. Then Asia is sort of a new frontier for search funds. And I think, for instance, in India, there have been a couple, but it's been complicated. And part of the complexity is the lack of free flow of capital, the restriction by the Indian government on debt, but also more importantly on foreign equity is a problem. It's doable, but, and I think those investors either from Europe or the US or now increasingly Latin America who are really steeped in the search fund model, the basics that have really worked well in the past, those are common across all countries. So how do you get those lessons into the DNA of your investor group is a key question, but different for different markets. So in Latin America, I think there are a lot of connections to US business schools and to companies that have done it, companies like QMC and Jose and Rafael who who did a search fund and have kind of spun off other entrepreneurs and their management team and elsewhere. So you can access it maybe there. In Europe, I think it all starts with Simon, honestly, and Rob Johnson, and just the tree starts there. There are now many other really good investors, including a lot in Spain and in Germany increasingly, and other countries, France more and more, who have that understanding. So I think in Europe and Latin America, you can probably have a mix of local and sort of say US investors. It doesn't have to be US investors, but there are more there who have capital and know it and want to invest. As you go further afield, Central Europe, someone mentioned in the Q&A, that's a ripe area, I think. There's the economic things that are good. The rule of law is variable by different countries, so that can scare off some investors, but I think it's possible. So I would really I would want to mix if I were in any of those markets, but I might shift it more heavily depending on how much search fund wisdom I could get locally, or from people maybe who aren't local, but have local connections to Singapore or Poland or Brazil. I would look for that wisdom and look for maybe a little heavier local representation in those countries where it was harder for US people to invest.
Okay, thanks. One of the questions we're getting is do we see saturations in countries like mainly the US and Spain? Will, you want to take that one?
Yeah, so Simon, I just think Jan, if you look at the basic ratio of number of searchers to number of small, medium-sized businesses, I just don't think we're approaching saturation in any market. Certainly not in the US, which is gigantic, even with the significant growth in searchers. I think the country that's closest to saturation may be Spain, because there's been a very significant growth in searchers there, largely because of IESE. But still, that ratio is wildly out of whack. I don't think there's any reason to believe that that there's going to be saturation or that searchers are going to be running into each other, even in Spain. I would say there's a recent Spanish acquisition that closed in the last 60 days or so that I was involved with, participated in. I think it might be the single most attractive search company I've invested in the last year. So just, anecdotally, I think there are lots of interesting companies still in all these markets that have all of the economic characteristics we're talking about, even those with relatively small numbers of total SMEs. So I don't think saturation is a near-term risk for search.
I think there's some saturation in investors. So for instance, in Spain, I think or a country where there are a lot of search funds, you've got to, as an entrepreneur, probably look for more investors who have the right qualities and are willing to learn about the search fund model, but are not serial search fund investors. You're going to have a higher proportion who are not, because they're just busy and sort of full up. So, but don't get discouraged by that. That's a natural thing. But what Will's referring to is the most important thing, which is, are there good companies to buy? And I think I agree with him wholeheartedly that there are.
Wonderful. So your view on Mexico on that would be similar or different?
Just in terms of market saturation?
Yeah, exactly.
I totally agree with. Yeah, I agree with Will and Peter's points there. I think it's a non-issue.
Okay, good. A lot of students hear from search funds the first time when they go to business school, and often they do business schools outside of their country, and sometimes they want to stay in that country. Any view, and I'll shoot it to you, Sam, any view on doing a search within your home country or in a foreign country?
Yeah, I'm thinking about the UK and going back to the question earlier about minorities. I reckon 50% of the UK searchers have come from minority groups, and probably, off the top of my head, 5 out of 11, 4 or 5 have come from non-UK. They may have been in the UK before their MBA, to be fair, but 1 or 2 actually came to the UK to do an MBA. So I think it's absolutely possible. But I think one needs to think about the culture in the country and an understanding of what that culture is. Obviously, that relates to language as well, and the fluency of the language, and a desire to, a real understanding what it's like to live in the country. So I have had one searcher who came to see me and he wanted to do a search in a particular country. And I said, well, that's really interesting. He was from the UK. And I said, how long have you lived in that country? Or, what do you know about it? And he'd never actually lived there. And I thought, wow, this is a huge commitment that you're making, that you're doing it, but you think it's right, but you haven't actually had that experience. And I said, you know, good luck. I wouldn't invest. I'd happily sort of support you in some way, but I wouldn't invest. But why don't you, at least for your own reason, in your own sanity, go and give it a go, you know, work for a few years, get some connections, understand the culture from the inside to make sure it is a country you want to live in, and then come back. And this individual did just that, went there, got a job, came to the search fund conferences and kept in touch, which was smart. And then when he was ready, he came back and said, yeah, would you consider investing? And I'm now an investor in his fund. So I think it's, there are things that are bigger than search funds. And one is where you want to spend your life and how you want to spend your life. So that was sort of directing back. Again, Jan, I thought I've actually answered your question if I rambled on there.
Wonderful, wonderful. Coley, do you have any views on searching outside your home country?
Yeah, I think it is possible, but the bar's higher. And so the default, in my opinion, should be to go to where you're from, because you have just an embedded understanding of the way things work that will be somewhat more challenging. I do think the experience that Simon alluded to in the UK, and certainly in the US as well to a certain extent, supports that you can not follow exactly what I just said, and it can be successful. But I do think it's more challenging. So just ask yourselves, why are you doing this? Are you doing it because I want to live in that country? Or are you doing it because I think this is my best chance to go buy and run a business? And I think those are fair questions to be asked by investors, and most importantly, to ask yourself. And there's not a right or wrong answer, but being clear about how you're thinking about that is probably the most important thing.
Okay, thank you.
Yeah, and sorry to jump back in. Can I just comment on there? We talked earlier about what happens if the search doesn't work out or if things don't work out. But what we haven't really touched on, and where it might be if someone's not in their home country, is what happens if you want to leave. And that's incredibly difficult. You know, you have to go through a sale process probably. It's not like a job, it really is a career. And that's something that's sometimes difficult for people to understand when they first start looking at search.
Wonderful. Thanks for that. One of the things I was at least surprised of, and I know some of you were too, was the age of the sellers. I think for a long time we thought this is mainly succession play, but if you look at the data, and thanks for providing those, Peter, you know, it is far much wider than a lot of us suspected. You know, what is your findings on that, Coley? How do you see that, and what learnings do we draw from that?
Yeah, I think there's still, you know, the consistent theme of someone who wants to retire and exit the business. The search fund entrepreneur provides them a differentiated ability to do that. And it's one of the competitive advantages of the search fund model. And I think that will always persist. The difference is, though, that there are some people who started their business very early in life. And after 10 or 15 or 20 years, that's enough. They have enough embedded wealth. They have enough experience. They have enough exhaustion from being the general manager that they are happy and looking for the next thing. Or in some cases, they're happy to sell and just do what they were really good at, which is be the CTO of the company versus the CEO of the company. So I think we will continue to see the trend and the variation there. I think particularly as some business models such as software continue to grow in their attractiveness to be acquired through the search fund model, that will pull down the age of sellers. But we are also will continue to see the folks who are, you know, in their 50s and 60s or 70s, who this is their way to get out, both from a liquidity perspective, but really also from a lifestyle management perspective. So no, I'm not concerned about it at all. I think it's just additional opportunity as different types of businesses are now being considered for the right reasons to be bought.
It's a great lesson, because when I was searching, I thought if a seller were 40 years old, I was suspicious, and why would they sell their company? There's something wrong with it that they're not telling me. I've completely changed on that. And part of that is just because of what the data shows. And I've seen people buy really good companies from younger sellers, but also I realized that I was good at running a company from a certain size to a certain size, but not above that or below that, frankly. And I think people have skill sets. I know brilliant people who are better CEOs than I, that are great at starting companies or great at growing them through a certain range, but not all ranges. So just find the right circumstance.
Sara,
I think it speaks to the saturation point too. It's just you would previously, people wouldn't have looked at those companies that maybe had the younger owners, but the data is proving that that's actually a very viable piece of the pie here as well.
Yeah, I would expect some searches now also moving downwards in terms of age. I think some of the searches limit indeed 50 plus, but are now going to be motivated by looking indeed at younger potential sellers. That's great. Now, I have a question for you, Sara. Search funds are getting larger. We see the amount of money they're raising is getting larger. There are more teams in that also. Does that affect economics somehow, and does that worry you or not?
I think deal size is, of course, a factor when you're looking at it through the lens of searcher economics. But I think ultimately the overwhelming factors that ultimately impact the searcher economics are buying a good company in a great industry. And we've got lots and lots of examples of entrepreneurs who bought small companies who've had fabulous outcomes for their investors and in the context of this question for themselves. So, just like we talked earlier about not entering a partnership because, the data is saying that partners have better outcomes. I think the same holds true here. Really be disciplined about the type of company you're buying because you think it's a great fit and meets the right criteria, not necessarily because you think the outcomes will be better, because at the end of the day, that's just, the incentives aren't aligned there and it's not going to work out. So I think ultimately you've got to really focus on just buying a great company. And if you do that and lead it well, things will work out.
And if you that, Coley, do you see, bigger companies, for instance, being, more attracted by people who raise bigger searches? Does that affect the numbers in some way, shape, or form or not?
Yeah, I don't think there's as much correlation between a bigger search fund raise, so $600,000, $700,000, $800,000, as it is between just having two people. I think that is the bigger driver. It's not so much how much money is raised. But I think that time to buy the business, it's becoming more, I think, almost a sort component of entrepreneurs, right? Some entrepreneurs are more interested in buying a smaller business that has a different type of higher growth profile, willing to have sort of the challenges and opportunities that come with that. Others might be looking for something that's more stable, bigger, steady, what have you. And we've seen success in both sides of the coin. Personally, I think there is no substitution for some minimum scale that does give you the ability to hire and build the team. I do believe there's a myth out there that you're going to buy a company and cut a bunch of costs. That's just never what happens. Often everyone has to invest more and build the team and spend a couple years growing EBITDA, hopefully maybe not as much as you otherwise could, but because you're making those infrastructure investments for the future. It's really hard to do that when you start getting down into the sub $1 million or even $1 to $2 million of EBITDA acquisition. Then if it's growing fast enough, then that's fine. But in the absence of that, if you can start with 2 to 3 to 4 million EBITDA, which is not easy to find for sure, I do think you've got just a lot more Play-Doh to work with as a young CEO to then go and build the business.
Will, do you have any other views on that or anything you want to contribute?
Yeah, I think, it is one of the reasonably striking findings in the Stanford study. There's size is down a, reasonable amount, with decent sized ends across both. So that's interesting. And in the European data, it also looks like it's down a little bit size wise in terms of EBITDA versus the two prior cohorts. I think that's, but not significantly. It's in the range Coley just described, maybe towards the lower versus the upper end of that range. I think that's probably just a rational reaction, again, to overall frothy markets. As you get to the top, as you get near the top of Coley's range, you're more likely to run into potential private equity competition. You're more likely to move beyond the valuation band we've been talking about. It doesn't happen in every case. So I think, that may logically be driving searchers to slightly smaller transactions. If they're looking at smaller transactions, they need to be able to compensate with more growth opportunity to make the math work, particularly in partnerships, so there's a bit of a dynamic there, but I think, that is that does come out in Peter's study.
Wonderful. A question for you, Peter, but I'm happy to open up to everybody because you're all sitting on boards. In one of your studies, you folks looked at boards. It's not in the most recent one, but how would a good board look like, and what do searchers appreciate in a good board, and what do investors appreciate in a good board?
Oh boy, I mean, what do searchers appreciate? And everybody appreciates a board that can support the management team. So, you know, there are kind of basic functions to boards besides choosing the CEO, which you don't have to do very often here, maybe 1 out of 20 times. Is there a change? But otherwise, it's both understanding and owning the strategy and coaching the searcher and really quickly telling them when they're off track, but also really supporting them and helping them in kind of a lonely and new and exciting and fun but scary job. And then there's a secret sauce to boards that is really helps the CEO be just a little bit better by having a better network, maybe, and making decisions just a little bit faster. That's all built on trust. So I think that's fundamental to both investors and the entrepreneurs. Is there just a really high degree of trust? Trust comes from many things, but financial alignment certainly, but also, you know, familiarity and knowledge and maybe networks that overlap. That's why culture matters and where you search and how you choose your board. It's not determining, but it matters. So I think boards that are highly trusted and highly capable at advising CEOs on running similar businesses, young CEOs, because I found private equity, really great private equity company board members have to learn a bit to be really good on search fund boards. So good at advising and providing that secret sauce to new CEOs with a great dose of trust are what people are looking for. That wasn't super articulate, but that covers a lot of it.
Wonderful. Coley, building on boards, you know, as Peter already mentioned, there's a lot of money coming in, a reasonable amount of money coming into this space. There's not the same amount of, you know, experienced board members coming into this space. You know, is there any advice you would have to people who are new to the space and sitting on boards?
Yeah, that's a really important topic that if I think about one of the challenges for the future, this is definitely a challenge. There's a logjam of rising amount of activity and new searches and acquisitions and a constrained supply of people who have the backgrounds that Will described earlier between operating or deep search fund investing experience, who bring a different level, number one, of patience, I think, and empathy for what the first time CEO is actually going through. And then an ability to actually engage in that and work in that from a coaching perspective. It is super, super critical for sort of, I think, the persistence of performance persistence, if you will, going forward, which is what, you know, entrepreneurs and investors care about. To your specific question around advice, I think it's important to try to find people to lean on either on the board with you or outside of that who have those types of experiences and seek out their advice and guidance for how to engage with the entrepreneur and the first time CEO as he or she goes through the different phases, which is, you know, the first 6 months is just learning and listening. And the next 12 months is actually doing some stuff yourself. And then thereafter, it's actually learning how to really become a CEO. Whereas I said before, you can work on the company, but not in the company. So I just can't impress enough about how I think that's something that's overlooked as an important critical success factor to maximizing the probability of that young CEO coming up a successful development curve. So to the extent folks can pull in other points of view and feedback if they don't have that experience themselves, it will go a long way to helping that entrepreneur who you may be working with. And I think a long ways to helping build trust, as Peter said, broadly around the world, to be able to say, yeah, this is something I enjoy and can be helpful doing. And because we all have to work together to make this model work, which is one of the best parts about it.
So is there anything done on women and minorities to get people on the board? Because I assume like there's something to be done there too, isn't there?
Well, I think, I hope I have a great answer for you next year, Jan. But right now, you know, there are no tangible initiatives in place, but really it's a function of, we have 6 female CEOs, search CEOs in the US today. They are very, very busy running their companies on a day-to-day basis. But as they get farther along in their career trajectory, and similarly with our CEOs who are from minority groups, people of color, they will be awesome board members. And again, that flywheel will continue. So there's no formal initiatives now, but it's certainly top of mind. And I think soon we will have a big enough group of people that they will start rising into these board positions and be able to play that important role with the next, generation of up and coming entrepreneurs and CEOs.
I will say that if there are any, women of color who want to do search, if they contact me directly, I will try and connect them with mentors to support them doing it. I won't say, I have to assess whether I think they're good for it and whether they will buy, when they find a company, if it's a good company in a great industry, but I will go out and spend some extra time trying to connect them and support them, because, oh my gosh, if we got, there's just a segment of the population who could contribute jobs and growth and entrepreneurship and wealth creation for themselves and their families and their investors that we're missing. So I'll throw that out to try and help.
That's wonderful. Thank you, Peter. With this, we'll end it, and hopefully, in our webinar 2 years from now, we can report back on those initiatives. I'd like to thank you, Coley and Sara and Simon, Peter, and Will, to be part of that. You guys have always been generous towards the IESE, towards us, but also towards this community. And thank you for doing so. And I'm looking forward to seeing you all. Thank you. And thanks to everyone.
Thanks very much.
Thanks,
Thank
John.
So much.
Everybody.
We will try and answer all the questions. All the questions. There are 73 questions in Q&A. We'll try and answer those among us, and then post them on the IESE and Stanford Search Fund websites.
Thank you.
Thanks, everyone. Bye.
So
Bye, thanks.